You don't get these multi-month corrections anymore. Now they're measured in days, and frankly, we expect to see silver reach, on my minimum is like 200, but I wouldn't be shocked. But if it approach 500, tell you the truth, eightfold says somewhere about 500. Okay, we're 500. We're only a fourfold move. We're only half the dimension of the prior two bull markets. What if gold does it again, which is hardly like a shocking thing to have another eightfold, and it's coming out of the ground at 7-1. And in other words, 7 ounces of silver for every 1 ounce of gold, yet it's still priced at upper 50s, 56-1, but it was at 120-1 in March of 2020. It was at 85 or 90-1 most of the last several years. So it's beginning to move back towards not only its historical ratio, and everything always does regress to the mean, regress to the average. In this video, veteran market analysts Sandy Scheckman and Michael Oliver explain why gold and silver are still only midway through a historic monetary bull cycle, despite recent explosive moves. They outline how modern corrections are now measured in days rather than months, signaling a market under intense structural pressure rather than speculative excess. Gold, they argue, has completed only about half of the magnitude seen in prior secular bull markets. If gold were to repeat an eightfold move similar to previous cycles, price projections could extend well beyond current levels, pointing toward a potential move above the $8,000 range over time. This has direct implications for silver, which remains dramatically undervalued relative to gold based on long-term ratios. Silver is described as the asymmetric trade with natural production ratios near 7/1 and historical gold to silver ratios reverting from extremes above 100/1 toward their mean. Silver price projections of $200 are viewed as conservative, while scenarios approaching $500 are not dismissed. The core takeaway, both metals appear far from their final highs, and the repricing process may accelerate as ratio compression continues. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview. Gold is a way to maintain your purchasing power and in some cases accentuate it. Now you can take any asset you can think of and do this with. Go back to 1971 and you'll even see, since we left the gold standard, that all asset prices are deflating against gold and massively inflating against a falling dollar. So in other words, gold didn't go higher, that dollar just keeps falling, and that's built into the system and it's accelerating. So yes, you own gold not to become wealthy. To see in gold terms, any asset you can think of is going down in price and it's deflating against real money. And that's the whole reason to have a gold standard, is that you have stable prices, or even that deflate. In other words, a better standard of living, right? If prices are going down and, but instead prices keep going up, which makes wealthy wealthier, right? This is the whole concept of those closest to the gold or to the money spent become wealthy disproportionately to those that aren't, because those people who have assets and can buy more assets, their value goes way up. And you contrast it with the people who don't. By the time the money gets filtered down into the public who don't have assets, just trying to make ends meet, it manifests in the form of higher inflation, higher costs of living. And that means the wealthy whose assets are inflating become exponentially more wealthy. And the people who don't have assets, just trying to keep it all together, well, they're having a harder time doing it. It's the K-shaped economy. If I would much rather hold my money in gold and silver than in the dollar, which again, using this analogy, sorry to use it now 3 times, is a melting ice cube. It is, and its value continues to massively decrease every single year in terms of its purchasing power. And, I don't know. I mean, this has been going on really since 1913, where the dollar has lost 97% of its value and purchasing power since the establishment of the Federal Reserve. So, this is why we hold gold and silver. This is why the central banks are buying it hand over fist. This is why the most connected, well-informed money on the planet's doing it here for the last 15 months. They know something's coming, and they know holding your money in dollars is not the place be, or treasuries. So yes, I think gold and silver are being rewritten into what is, maybe a new monetary system, and realizing that silver is critical for a country that wants to remain relevant in things like high-tech military and AI and solar panels and digital electronic ecosystem. You need it. And if you don't have it and you're relying upon countries that are in essence your foe, even friendly foe, you're at a disadvantage. And that's what's being realized right now. Yes, on top of it, the United States government classified silver a critical mineral. Jazz. Do you think the U.S. government could maybe be taking possession of 100 million ounces of silver? I don't know. Sure seems that way to me. And forget about the fact that the European Union did it a year ago, and forget about the fact that China, everyone talks about them tightening the noose on exports. Well, what people don't really talk about is what they said in November, which is that we are prioritizing silver for domestic needs before anything else. Then they put on the export restrictions, and they're responsible for refining 70% of the world's silver. Dory, yeah, things are getting very interesting, but in terms of the noise in the periphery, what else do you need to know? But that the biggest money in the world, who knows the information, actually probably creates the information, or is real close with those that do, says, yeah, let's stamp for possession every month of billions and billions and billions. And the fact that it has outperformed, both gold and silver have outperformed just about everything. Gold, going back 25 years, has doubled the 10-year treasury, has no counterparty risk. Look at it over the last few years. 2 years ago, gold up 45%, the 10-year treasury up. That's 10 times the gain. No counterparty risk. Last year, gold up 80%, the 10-year treasury up 4. That's 20 times no counterparty risk. Look at it. Look at where we are at silver. Silver up 50%, 10-year treasury up 4. I think what you are seeing is the fact that it's an issue of trust. People don't trust. Not only do they not trust really the institutions that are issuing the treasuries and the government standing behind it, who, to your point, can sanction, but it's also a lack of trust. I think in the markets in this video, the discussion breaks down why gold and silver are not about speculation, but about preserving purchasing power in a monetary system built on currency debasement. Since the end of the gold standard in 1971, all assets have inflated against the dollar while simultaneously deflating against gold, revealing a simple truth: gold hasn't risen, the dollar has fallen. This structural decline is accelerating, creating a widening gap between asset holders and those dependent on wages. A classic K-shaped economy. Gold and silver are framed as monetary anchors in a system where fiat currencies continuously lose value. Central banks understand this dynamic, which is why they are aggressively accumulating precious metals while reducing exposure to dollars and treasuries. Gold's lack of counterparty risk and its long-term outperformance versus government bonds highlight a growing trust deficit in financial institutions and sovereign debt. Silver's role extends beyond money. It is increasingly recognized as a critical strategic resource essential for military technology, AI, solar energy, and digital infrastructure. Governments classifying silver as a critical mineral and prioritizing domestic supply signal rising geopolitical urgency. With global supply chains tightening and export controls increasing, the physical demand story is becoming impossible to ignore. This is not noise or hype. It's a shift in trust, power, and monetary relevance. Now let's get into the interview. but in the month of December, there was 37,600 ounces of gold delivered on COMEX. Well, 37,600 times, what, at the time, 4,300 an ounce. Do the math. You're at, 13. And how about, the 730 rather, 730,000 troy ounces of silver stopped and issued and stopped. That's the same thing as delivered. You know what? What's 65 million ounces of silver worth at $80 an ounce? And if a mint box of silver maples or eagles weighs 42 pounds, what does 65 million ounces weigh? And at this level, it's not even the money, Darl, as much as it is the information that is pushing these people to do it. Now, this has gone on again. Here we are in January, and we've seen roughly 6 or 7 days on the delivery month, which is not a major scheduled delivery month. Yet we've already seen in silver almost 7,000 contracts stand for delivery. About pretty damn close to 35 million ounces of silver has already been delivered in January. So between December snorts and January, you have 100 million ounces of silver that has stood for delivery. Now there's still another 2 weeks left in the January contract. But this has been going on every single month. And I've been screaming about it on a central bank level since 2020. You go back and watch any of the 6,000 videos I did in that time frame, and you will see this has been a primary thesis of mine, that when the most well-funded and well-informed traders on the planet take possession and remove counterparty risk, stand for delivery at these kinds of numbers, which we've never seen this before on COMEX. What we are witnessing now is not a normal market fluctuation. It is a structural break in how gold and silver markets function. Delivery data shows unprecedented amounts of physical metal being removed from the COMEX system month after month, even during non-major delivery periods. This isn't about price anymore. It's about information, trust, and the deliberate removal of counterparty risk by the most informed participants in the market. When tens of billions of dollars worth of gold and silver are demanded in physical form, and when this behavior persists consistently, it signals a deep shift in confidence away from paper claims and toward tangible assets. These actions suggest that sophisticated players are no longer willing to rely on promises, leverage, or rolled contracts. They want possession. This pattern has now repeated for years, accelerating rather than fading. The scale and frequency of deliveries point to a system under stress, one that was never designed for widespread physical settlement. As physical inventories tighten, the implications for price discovery, volatility, and market control grow more serious by the month. This isn't hype, it's math. Logistics and behavior converging in real time. If these trends continue, the precious metals market may be approaching a point of no return, one where physical reality overrides financial engineering. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.